Did you know that using the wrong valuation method could cost you millions of dollars with your multifamily investment? Learn how to understand your multifamily's investment the right way so you know what you are doing from the very start. Now, using the wrong valuation method can lead to overpaying for a property, misjudging its cash flow, or simply missing out on a great investment opportunity altogether. Now, today in this video, we're going to cover 3 common multifamily valuation methods, how each one impacts your deal, and why choosing the right one is crucial to your success as a multifamily investor. Hello everybody and welcome back. For those of you watching for the first time today, I'm Paul Macaluso, the Multifamily Renegade, and the goal of this YouTube channel is to help you with your multifamily investing through my years of experience as a multifamily owner-operator, as well as a commercial real estate broker specializing in investment sales of multifamily property. Let's jump into the 3 valuation methods. Method number 1, income capitalization, better known as cap rate. Most of you guys have probably heard of cap rate as a form of valuing a multifamily property or any other income producing piece of real estate. Now, the income approach values the property based on the net operating income and that particular market's cap rate. This is great for properties that are cash flowing and that you plan on acquiring with cash. If you plan on buying your multifamily property using leverage, then you are going to need to dig a lot deeper to understand the investment better. And we're going to get into a look over the shoulder portion of this video in just a second, where I break down how to understand a cash on cash return when using leverage. However, let's get into an example of a cap rate. Now, if a property generates $100,000 in net operating income and the cap rate for that particular market is 5%, the property would be valued at $2 million. Moving on to valuation method number 2, which is comparable sales approach. Now, this is a very common valuation approach, and actually when you're looking at residential property, it's the only valuation approach that is used. However, in multifamily investing, there's several valuation methods, and we're going to go over the 3 today, and method number 2 is comparable sales approach. The market approach uses recent sales of similar properties to estimate the value of the property that you're acquiring. It works well in appreciating markets, but it can lack some reliability in downturns. For example, if a nearby multifamily property recently sold for $2.5 million, you can use that as a benchmark for your property's value. Now, when you're using leverage to acquire a multifamily property, the 2 most common valuation approaches that an appraiser is going to use is number 1, the income approach, and number 2, the sales comparable approach. Now, when we get into approach number 3, this is typically used for something a lot larger. But when you're looking at most multifamily properties between 5 and 100 units, the 2 most common valuation approaches are going to be the income approach and the comparable sales approach. Moving on to method number 3, which is replacement cost approach. And again, guys, most of the time for the properties that you'll be acquiring, you're going to be using the first 2 valuation approaches. However, there is a third, which is replacement cost approach. Now, this approach calculates the cost to rebuild a property from scratch. It's very useful for older buildings in a market that has limited land supply, or when land and construction costs are going to play a role in your acquisition. For example, if it costs you $150 per square foot to rebuild or build a property, and the building size is 10,000 square feet, the replacement cost will be $1.5 million. Now, let's go ahead and jump into the look over the shoulder portion of this video, where I break down how to calculate a cash on cash return. When you are calculating cash on cash return, you're typically going to be acquiring the property using leverage. Now, for sake of argument and to keep things very simple, we're just doing this example based on a simple loan to value. Obviously, if you're planning on rehabbing a property or implementing a heavy capital improvements program, you're going to need to factor in more cash. But this is just simply calculating it based on a down payment. All right. So let's say, for example, we have a purchase price of $1 million. And that $1 million property throws off $100,000 in net operating income. If we look at the capitalization approach or the income approach, that's going to give us a 10% cap rate. However, we're using leverage in this example to acquire the property. And we're looking at this from an 80% loan to value. So the bank is going to lend us $800,000. We're going to put $200,000 out of our pocket down on this property. Now, the debt service that we're going to be using to carry this property is 6.5% on the interest rate. So debt servicing is going to cost us on an annual basis almost $65,000 a year. When we look at the net income after our debt servicing, our cash flow after debt service is $35,188. And this is going to leave a 17.5% cash on cash return. And again, guys, if you're going to be implementing a heavy capital improvements program, or there's origination costs with the loan, whatever cash that you're coming out of your pocket to acquire the property is going to need to be factored into this particular spot up here, which just shows your down payment. You're just going to line item more cash out of your pocket in that particular section before you subtract the debts, or come up with rather the debt service and subtract that out of your overall cash, your net income that the property is producing, which is going to change your net cash flow as well as the cash on cash return. So I hope that helped you guys understand a little bit better how to look at a property when it comes to your cash on cash return, especially when you're buying multifamily property. So choosing the right method depends on the property type and your goals. Are you buying for cash flow strictly, or are you looking at appreciation over time, or are you looking to develop something from the ground up or add more units to an existing property? All of that's going to need to be considered when you're coming up with the valuation method you'll be using for the multifamily investment that you'd like to take down. And having a clearly defined investment and end goal for that investment worked out from the very start is going to give you guys a huge advantage over most other investors in your market who don't have this figured out. So underwriting correctly is more than just formulas. It's about understanding the property's unique characteristics and how the market impacts its value along with your end goal for that investment. So if you guys like this video and you have an example of what you've done to use a valuation method, either one of these three or something different that you use for your multifamily investments, please drop me a comment below. Let me know. Let's have a little bit of a dialogue. I'd love to hear your experiences. And if you have not already subscribed to the channel, please make sure you do so before leaving today. I try to drop 2 videos a week for you guys, so make sure you hit that notification bell so you never miss out on a new video that I'm dropping. Of course, if you like this video today or you like any of the other videos that I'm dropping, please give it a thumbs up. Certainly helps us out. So that's going to do it for today's video, guys. Thanks for watching, and I'm Paul Macaluso, the Multifamily Renegade, signing out.